I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
Barry Sternlicht, a prominent figure in the finance world and the CEO of Starwood Capital Group, managing over $120 billion in assets, is sounding urgent warnings about the real estate market. Sternlicht draws a vivid comparison, likening the impending crisis to a Category 5 hurricane. His warnings act as a crucial reminder of the potential challenges looming in the real estate sector. Now, let's explore Sternlicht's perspective to gain a deeper understanding of the gravity of this unfolding situation. But before we proceed, make sure to hit that subscribe button. Stay tuned till the end of this video to learn more about what this means for you. Understanding the real estate storm involves examining its connection to another critical factor: interest rates. Real estate behaves akin to a consistent source of income, much like a steady job salary. For instance, envision owning a small apartment building. Annually, it generates $100,000 in rent, akin to a reliable wage. This steady incoming revenue is referred to as the income stream of the building. Deduct the expenses for repairs, taxes, and maintenance from this income to arrive at your net income from the property. Now, let's bring interest rates into the picture. Picture this: you have an opportunity to purchase another apartment building similar to the one you own. However, this time you'll need to take out a loan. The monthly amount you must repay, the mortgage payment, is contingent on the interest rate set by the bank. If interest rates increase, your monthly mortgage payment also rises. Consequently, you have less money left from your building's income stream. It's akin to your salary decreasing. This reduced net income makes the building less enticing to buy. Typically, when something is less appealing, its price tends to decrease. This is why higher interest rates often result in lower real estate values. When Sternlicht refers to a Category 5 hurricane, his concern revolves around the potential impact of rising interest rates on real estate owners. This could lead to tightened financial constraints for many, resulting in possible price drops and a slowdown in the real estate market. Let's consider a $100,000 a year apartment building. The rent increases by 5% each year, similar to a raise at work. After 5 years, you decide to sell, anticipating a nice profit. But what's its current value? This is where cap rates come into play. It's a method to estimate a property's value based on its yearly income, resembling a price-to-earnings ratio for stocks but tailored for buildings. In this example, let's use a 5% cap rate. We take the building's yearly income of $100,000, divide it by the cap rate, 5%, and voila, we get an estimated value of $2 million. But hold on, we're not done yet. Don't forget about inflation. Money today is worth more than money tomorrow. To get the real estate value, we need to adjust for that using another concept called discounted cash flow. It's like taking all the future income from the building and determining its value in today's terms. This process involves using an interest rate, let's say 6%, to perform these calculations. After running all the necessary calculations and factoring in the discounted cash flow, it turns out that our seemingly modest apartment building is actually valued at approximately $2.28 million in today's terms. Well, let's see what happens when the interest rate storm hits. Adjusting these rates significantly impacts the present value of the building. Increasing the discount rate from 6% to 7% implies a higher time machine tax, reducing the building's value to $2.18 million from the previous estimate of $2.28 million. But the storm isn't subsiding yet. As investors seek larger returns, they demand a higher cap rate when purchasing the building in 5 years, increasing it from 5% to 6%. This adjustment further diminishes the building's future value, eventually lowering its present value to $1.89 million. Now, let's take it a step further. By elevating the discount rate to 9% and the cap rate to 8%, it's akin to a hurricane of interest rates hitting the property. Consequently, the apartment building's value plunges dramatically to a staggering $1.41 million. This fluctuation in value, despite the building's steady income, highlights how rising interest rates can substantially decrease the value of real estate investments. This is why Sternlicht and others are concerned. Higher rates have the potential to shrink the value of numerous real estate assets. The fear is that the prosperous times in real estate, characterized by healthy cash flow, might not persist, possibly leading to a recession in the U.S. It all comes down to the fundamental principles of supply and demand in the real estate market. Rising interest rates might scare off borrowers, slowing down new construction. That could mean less supply, potentially pushing rents higher and keeping the real estate market afloat, at least for a while. But if the economy sputters and people lose jobs, suddenly we could have too many apartments and not enough renters, driving rents down and dragging real estate values with them. A healthy real estate market means more people want apartments than there are available. High demand, low supply. That's like a long line outside a popular restaurant. Landlords can charge more rent because everyone wants in. In recent years, a booming economy brought more jobs and cash, causing home prices to soar, leaving many stuck renting. This led to higher rent prices and increased the value of apartment buildings. But when the economy slows, job losses force people to move in with others or face eviction, reducing apartment demand. At the same time, new apartment buildings, planned during the good times, flood the market just as demand drops, creating an oversupply and significantly lowering rent prices. Barry Sternlicht's primary concern revolves around two particular types of buildings: office spaces and retail properties. Regarding offices, a significant factor worrying Sternlicht is the impact of remote work, especially in the U.S., where many individuals have yet to return to their workplaces. However, he highlights that this isn't the prevailing situation everywhere. In places like Germany, there are low vacancy rates, indicating that most offices are occupied, with people having returned to their workplaces. Similarly, even in regions like the Middle East and Asia, there's significant activity in office spaces, suggesting that remote work hasn't had as strong an impact there compared to the U.S. Barry Sternlicht predicts a two-tier system for the U.S. office market. 1. High-quality buildings. Modern and attractive offices, characterized by a pleasant working environment, are likely to remain fully occupied. People enjoy working in these spaces, contributing to their sustained popularity. 2. Average and below-average buildings. Older and less appealing offices may encounter challenges, facing potential vacancies. Some of these buildings might become empty, resembling fields of grain, prompting the need for repurposing into parks or alternate uses. In certain cases, it might be more cost-effective to demolish C-class buildings than keep them empty, leading to potential transformations into green spaces. As for the question of whether houses will become cheaper, Sternlicht, a major player in the housing sector, suggests that prices might eventually decrease, but he acknowledges that the situation is complex and involves multiple factors. Prices may hold due to interest rate hikes, which discourage homeowners from selling and keep houses scarce, maintaining higher prices. Additionally, homeowners with low mortgage rates are less inclined to sell while those rates benefit them. However, prices might drop if interest rates decrease, prompting homeowners to sell and flooding the market with more houses. Moreover, increased stability could lead construction companies to build more houses, adding to the supply and potentially causing prices to drop further. The housing market may stay flat for a while, but in the long term, it's expected to rebound. Buying a house in the U.S. is tougher than ever due to soaring prices, jumping from $315,000 in 2018 to $416,000 in 2023, and a doubling of mortgage rates to around 7%. Housing affordability is at a historic low. pricing many Americans out of the market, and concerns about a housing bubble are rising. Despite expectations of high interest rates causing a price crash, homeowners with low-rate mortgages are reluctant to sell, fearing the loss of favorable rates. This limited supply is keeping prices persistently high. Wealthy real estate investors, like Ken Griffin, seize opportunities in crisis, such as buying storm-damaged houses in Houston at low prices and profiting as the city recovers. Figures like Jorge Perez play a crucial role in revitalizing areas affected by storms, essentially acting as a beacon of hope in rebuilding communities. Their efforts go beyond personal gain, impacting both the affluent and the less affluent, emphasizing the broader significance of real estate market fluctuations on society as a whole. When turbulence hits the housing market, it's essential to consider the collective impact on individuals from various socioeconomic backgrounds. The forecast for the next year and a half appears turbulent, perhaps even stormy, as Barry Sternlicht alludes. However, amidst the uncertainties, there's a glimmer of hope. Riding out this challenging period till 2025 might lead to brighter opportunities. It's a reminder that investing in real estate is akin to a marathon, requiring endurance and patience rather than quick gains. For deeper financial insights, subscribe to WealthMap. Thank you for joining us on this journey of learning. Until next time, remember to begin with small steps, dream big, and stay financially empowered as you shape your future.